Welcome to Building Better Communities with Bob Hart. This season, we're celebrating a major milestone for TruAmerica Multifamily. 13 years of building better communities across the country. In that time, TruAmerica has grown into one of the largest and most active multifamily investors in the U.S. Ranked number 23 by NMHC with 65,000 units and $17 billion in assets under management across 300 properties in more than 35 markets. Today, TruAmerica's strategies span value add and core multifamily, affordable housing, residential development, and structured finance. TruAmerica is focused on one mission, helping meet essential housing demand. Now, here's your host, Bob Hart.
Hi, welcome to Building Better Communities. I'm Bob Hart, your host, and today we're going to have a special mid-year outlook episode of Building Better Communities with our returning guest and longtime friend and partner of TruAmerica, Dr. Sam Chandan. Sam, welcome.
Thanks so much, Bob. I'm delighted to be here.
Good to see you. I just wanted to give a little introduction and shout out to Sam before we get started here. As a lot of you probably know, Sam is widely recognized as one of the leading voices in the United States and abroad in commercial real estate economics, capital markets, and housing policy on a national and global Institute for Global Real Estate Finance at NYU, Stern, research initiatives, industry engagement, and MBA real estate programs, both in New York and in Abu Dhabi. Sam is also the founder of Chen Economics, a contributor to Forbes, and a trusted advisor across the institutional real estate industry. And prior to being at NYU, he served as a chief global economist at Real Capital Analytics. And before that, he held leadership roles at Moody's Analytics through REIS. His works, Dr. Chandan's work spans commercial real estate finance, housing affordability, artificial intelligence and data science in real estate, urban economics, and broader macroeconomic policy. So our conversation today is a very timely mid-year outlook focus during a time of real transition in the real estate markets, what's happening globally and across the macroeconomy, how evolving capital markets and policy decisions are affecting and impacting Main Street, and what it all means for the commercial real estate industry, particularly in the multifamily sector, which TruAmerica and others navigate in. The last time we had this conversation, Sam, you and I were in Abu Dhabi doing this live in February of 25 at a different time in the world, and a lot has changed since then, and so has the outlook. So I'm looking forward to unpacking this with you today. And so, Sam, thanks again for joining us, and great to have you on the podcast.
Thanks so much, Bob.
So, Sam, let's start at the macro level. There's a tremendous amount of uncertainty in the economy today. We've had a long period of elevated interest rates. Inflation has come down, but has not disappeared. And the labor market continues to show mixed signals, yet the stock market's at all-time highs. How should investors in our world and operators be thinking about these broader macro forces, and how are they ultimately impacting the multifamily sector?
Sure. I think overall, the economy has shown remarkable resilience because whether we're looking at data, whether we're looking at anecdotal measures, what's clear is that people are really feeling that geopolitical and policy uncertainty. That's become part of our lives, and the world is evolving and developing quickly. Many of the things that are happening, both in domestic policy and globally, are going to act as drags on the performance of the economy. And that's because an environment of uncertainty means that individual firms and households are sometimes going to hesitate to make big investments, whether it's building a new factory, whether it's buying a new washing machine, buying a house. Those kinds of big investment choices become a little bit more difficult in an environment where it's harder for us to plan. But what we've actually seen is that the economy has continued to grow. One indication of that, as you mentioned, is that the stock markets, depending on the day, may or may not be right around all-time highs. I think one of the ways in which we can unpack that is to understand what's really driving that growth, what's really driving the stock markets to such highs. And a lot of it does have to do with the big investments that we're seeing in the economy's adoption of artificial intelligence, whether it be the investments in data centers, whether it be investments in the underlying infrastructure that supports AI, the building of new AI tools and platforms that are seeing major investments, from venture capital, from private equity, from equity markets more broadly. That's really a lot of the momentum here. So even when we look at GDP numbers for the United States, we just received a revision to the most recent set of GDP data. It shows growth in the first quarter was a little bit weaker than in the initial estimate. But when we look at the drivers, what we're really relying upon right now is that big AI infrastructure investment. Now that's an exciting thing because of the way in which AI is unlocking lots of possibilities for us. But it also means that we need to be a little bit cautious because such a significant share of economic growth right now does depend upon this big investment that we're making directly or peripherally into this sector. Part of what that is also going to reflect, Bob, is that there are many of us who are in the fortunate position of benefiting from gains that we're seeing in the stock markets, the relative strength of home ownership, our 401ks, our discretionary investment accounts, those are all up, and a lot of us are feeling understandably very good about that. But there are also a lot of folks in the country for whom the experience of the last couple of years looks really different. If you don't own a home and have not seen equity increasing, if you don't have a substantial retirement account to benefit from what's going on in the stock market, if your experience of inflation is very direct, and I think this is an important point. So over the last couple of months, given developments in the Middle East and the Gulf region, inflation has reasserted itself, and that's had an impact on the outlook for interest rates. I think what we see is that for a lot of people, their experience of inflation, of wage growth, of increases in the value of investment portfolios, for each of us, it's very, very different. And that means that there is a lot of dispersion, across the economy in terms of how all of this is playing out at the level of individual households. Let me turn it back to you there after that introduction.
No, that was great, Sam. It's interesting you mentioned the whole data center boom. We're now seeing at the congressional level challenges to that based on environmental impacts. We saw your Congresswoman, Ms. Cortez, on CNN last night holding a tainted bottle of water, claiming that these data centers are causing it. Do you see any pushback there yet, or is that just?
Yeah, I think not so much at the federal level. When we look at sort of who holds the balance of power in Congress, in the executive branch, I think folks are generally supportive of continued investment into data centers. Obviously, there's a possibility that balance of power and the public discourse and dialogue at the national level begins to change later on this year. We do see, though, and I think you're pointing to something really important here. We are seeing pushback. But right now, the locus of that pushback is not so much at the federal level. It is, at the local and state level. And I think it manifests as concerns about, water resource availability, the availability of electricity. And it's not even so much the generation of power. It's, the demands on our capacity for transmission, distribution. Yep. The possibility that utility, with very high demand. What does that over the medium to long term mean for the the price of electricity, particularly to consumers? And there is, I think, at the local level, a real, there's real NIMBYism, where not everyone wants a data center, in their backyard. One of the very interesting conversations I've had over the last couple of weeks with some colleagues that are in leadership roles at a public traded real estate investment trust that really focuses a lot of its energies, on the data center space, really is around, some of the dialogue that they're having at the state and local level, not only with, not only with elected officials, but also folks that are in leadership roles at, the public utilities. about sort of how it is that they might enter into contracts for power for new power generation that's under development. The inevitable question, because I think it's it's eye catching, or attention grabbing, this idea that we might put data centers in space. We're not there.
Oh, you stole my thunder. I was just going to say
Yeah.
Elon Musk is going to solve it all for us when
Yeah, I don't think
SpaceX goes public at $1 trillion and he gets the data centers in outer space.
I don't think we're getting data centers in outer space yet, particularly for applications where latency, is very important. The proximity, to the user of the compute was not important. Then we would build all of our data centers in places where, water, power, were most readily available, where temperatures were cooler, and where, of course, we have the data and energy pipes to get everything where it needs to be. But latency and proximity do matter for a lot of folks in this space. I think one of the things that we may see, again, it's not right around the corner, but one of the areas that I think many of us are watching very closely is the real potential for modular nuclear, where we're deploying very small scale nuclear power that is co-located with the data centers, particularly when there's a locus of data centers, as we have in Virginia. But I think if you think you have NIMBYism now, when you're talking to folks about putting a data center a mile or 2 miles or 10 miles down the road, imagine the kind of pushback you're going to get when you tell them that you're putting a small portable nuclear reactor near their kid's school. That is going to lead to a whole other level of conversation. So to your original point, yes, pushback, it's real because the demands on water and energy resources are very real. Right now, it's happening mostly at the local and state level, not so much at the federal level.
I gotcha. Well, let's fly back to planet Earth, where we have to all co-locate to run the outer space program, and talk about multifamily for a minute.
Sure.
How would you characterize the fundamentals today, looking across the various indices of occupancy, rent growth, concessions, affordability pressures, and where do you think our sector stands today, and where do you see fundamentals trending in the second half in this mid-year outlook for 2026, Sam?
Yeah, so I think we're coming off of a period, from 2024, 25, where we've had to absorb, significant deliveries. There's been, in many markets around the country, a lot of new supply, and it's inevitable that when you see a surge in deliveries, that will exert some upward pressure, on vacancy rates. That will be a point in the cycle where we see more modest rent growth, and in some cases and in some markets where we might actually see that rent growth turns modestly negative. I think when we look at the first quarter data, what we see, and again, there's some variation in reporting across sources, but depending on how what we're including in our institutional count of multifamily in the United States, what we're including in workforce in particular. But I think what we see in that first quarter data is, some real evidence of the market stabilizing, a larger number of markets turning positive in terms of rent growth, vacancy rates starting to trend down, and that is consistent with data that we have in that captures supply. What do we have under construction? What do we have in terms of deliveries? We really have come off the peak in a significant way, and that is allowing for absorption from the demand side, to catch up. For those of us that have been through many market cycles, I think we know that deliveries and new supply is not going to happen in a way that's as smooth as demand growth. Demand grows over time. It relates to everything from the interrelationship with the single family housing market, mortgage rates, population growth, demographics, immigration policy. But demand growth generally is going to look smoother than what we see on the supply side, where we'll get these sudden bursts. There'll be years where we bring more online. And that's going to lead to some that's going to support what we observe happening in the multifamily cycle. So last couple of years really have been, for a lot of folks, about the new supply that's come online. And I think the next couple of years are going to be about absorbing that, and that
Yeah.
does mean improvements in fundamentals. I'll say that some evidence that that is a view that is more broadly held than just me. When we look at the preliminary first quarter data on bank lending activity, mortgage originations, it does show in the underwriting an expectation of modestly improving fundamentals. We're not at a point where underwriting looks aggressive or unwarranted, but it does show an expectation. And importantly, amongst the folks in the market that have been the most consistently rational in the way that they're underwriting the debt, I think those folks are seeing those improvements happening, and the volume of lending has increased in a way that is not fully accounted for by just the need for refinancing the market. So those are positive signals of folks on the debt side, seeing some of those improvements that strong operators are seeing. I'll add one more here, Bob, which is that we do see some upward pressure still on delinquency and default rates in the multifamily sector. Now, as compared to office, retail, hotels, the levels we're talking about in multifamily are an order of magnitude lower. But whether it is some of the the agency debt, whether it is bank mortgage, bank multifamily mortgages, still some upward pressure there. Not numbers that look anything like GFC. That is not what we're talking about here. More importantly, though, when we dig in to try to understand, okay, where are some of these delinquencies and defaults occurring? In some cases, it's the subset of affordable, capital A affordable space in specific markets where there have been more significant constraints introduced on the capacity of operators to raise rents from year to year. In some cases, outright rent freezes. When at the same time, we know that there's pressure on expenses that is very real.
Right.
The other really is a story of folks that may own multifamily, but who may not be adept at operating multifamily, in a more challenging environment. The last couple of years, and I strongly believe the next couple of years, are going to reward multifamily owners and managers that really are sort of best in class operators. And if you are not a best in class operator, then it's a more challenging period for you in being able to sort of bring your skills to bear in tenant retention, tenant satisfaction, leasing up the available spaces. The important takeaway is that although we do have those rising delinquency and default rates, and again, not to levels that look anything like sort of a broad issue, but they really are concentrated in that segment of the market where we see that properties are owned by folks who are not really adept at sort
more
of
the mom and pop
navigating.
owner.
Yeah.
Sam, let's get a little harder because on population trends, the United States, I believe, for the first time in my memory, has actually had some, I believe, negative population growth this year as we have the aging of America, a lower birth rate, and we've seen a constraint on immigration, and now talking about sending people home that are applying for green cards and other pressures. How much of that is real versus headline? Are you concerned about it long term? Where do you think that fits into the equation?
Yeah, no, it's a really important question, Bob, because when we look around the world, I think we are entering a new demographic cycle globally. And by that, I mean, in the next couple of decades, we really hit peak population globally. And then we start to see global populations decline. And so, in the short term, certainly, we've got issues like immigration policy that are dragging on population growth in the United States. The longer term issues for us are what are happening with demographics, what's happening with fertility. Globally, just to zoom out for a moment, where we see some of the really big challenges are on an ongoing basis in parts of the Asia Pacific region, and most importantly in China. Between now and 2050, we actually see a very substantial population decline in China, and that will fundamentally change their economics in terms of how it is that they engineer growth. What we see here in the United States today is, again, there's a set of issues here. Some of that, you mentioned some of them. A lot has to do with sort of fertility rates. We are not having enough children in the United States to maintain or grow our population on our own. So we depend upon immigration. That means that we have to be very attuned to what is going on with immigration policy. In the short term, that is acting as a drag on population growth. In the medium to long term, the consensus, amongst policymakers, economists, is that the United States will continue to benefit from something that makes us unique in the world, which is that for all of the challenges and uncertainty that we've got, we're the fastest growing G7 economy. Over the long term, will be the most consistently, the expectation will be the most consistently growing economy. And if what we bring, when we think about sort of what we could really ground that in across cycles, is that we have a greater capacity for innovation and entrepreneurship than really any other, economy of size, anywhere in the world. We're a big country, but even once you adjust for that, we punch so far above our weight in terms of our
alpha as a nation.
Yeah, we really do. And that means that the United States remains, for all of the noise out there, it really does remain, the destination of choice for a lot of people around the world. So notwithstanding the vagaries of the policy and political cycle, the expectation is that medium to long term we continue to grow, but immigration is an important pathway for that. In the short term, as the immediate impact of more constrained immigration policies, actually to see some folks leaving the country. I think that's what you're seeing the effect of now. We don't have an infinite supply of folks to who might exit or emigrate from the United States, and so some of this is relatively short-lived. As a particular policy seeks to rebalance where we are in the country.
Well, the good thing for at least the multi side of the industry is that despite an aging population, the span of rentership is much longer. People are getting married later. They're delaying household home purchases. And, selfishly, it's a good thing for the rental industry. We're becoming more and more of a renter nation than we ever have been.
Yeah, and I'll say that that is something that is not just multifamily industry talking point, right? That is very clear in the demographics that we are buying homes later. There are different estimates. When we look at the when we look at credit score data, when we look at mortgage application data, when we look at data from Mortgage Bankers Association or some other or National Association of Realtors, there's going to be some differences there, in what they're reporting as median age of first-time home buyer. But it's the directionality is clear. We're having children later. We're having fewer children. There is no evidence of that reversing course, and so that is critical for how we think about the age at which people begin to sort of shift tenure bias from renting to owning. So that in itself, the demographics support rental demand. There is another feature of this market, which is that while there's currently some softness in single family, maybe not in New York City in the condo market, but in many parts of the country, we've seen some softening in the multifamily sector. There's still significant upward pressure on mortgage rates, and for a lot of younger individuals, younger households, and younger families, the capacity to save towards a down payment on a home, is a binding constraint. That is, and that defines the universe of folks that are renters by necessity. We still also have lots of renters by choice, and that is sort of a segment of the population that continues to grow. So when I think about sort of what rental demand looks like in the United States, again, for those of us who've been through cycles, we know that there will always be some ups and downs. But on a more long-term basis, the demographics of multifamily demand, I'm quite bullish.
Yeah, let's thank you for that. That was great. Sam, let's shift away. Let's go from Main Street to Wall Street, not far from where you are there at NYU.
Yeah.
And talk about the current capital markets and the investment environment, there's been a wide range of opinion and a lot of data points about transaction activity. Most people you talk to on the service side, the brokerage side, are struggling to eke out earnings in the last couple of years, and including this year. The saying was stay alive till 25, and now it's you'll be in heaven in 27. And
Sure.
we're
going to need to think of a few more
out.
rhymes before this is over.
Or as I said at NHC, more to fix in 26.
Yeah.
But from your vantage point, are we beginning to see transaction markets recover? Are the participants still largely stuck in a price discovery mode? And what do you expect for investment activity and capital flows from now, mid-year to year end?
Yeah, I think sort of when we look at sort of the initial take on transaction activity during the first quarter, and some of the preliminary data points on second quarter transaction activity, there's some variation in your source, but it looks modestly positive. The multifamily sector looks a little bit better. It's clear that there are still issues around price discovery, and that some parts of the country, some markets are doing better than others. In a twist for multifamily as compared to where we were a few years ago, before that surge in supply, some of the markets around which that have been demonstrating the strongest fundamentals because of the strength of the demand side in the Sun Belt, are now markets that are working to slowly absorb what's come online, and so underwriting is a little. I think what we see is that there is their capital, where both institutional and institutional, that is looking for investment opportunities. There is again still some issue around price discovery. I would say that in March and April and even a little bit in May, it's not that cross-border investors and even some domestic investors have said we're not doing business in the United States, but we absolutely see that many cross-border investors have been doing stronger due diligence, right? It's an environment of higher uncertainty. They want to understand, what current policy means for inflation, what it means for the availability of capital, what the near to medium term job growth outlook is for the United States, and so we don't see a loss of interest, and we see people actively looking for acquisition opportunities. But it is fair to say that people are quite understandably doing stronger due diligence and asking more questions.
There's no shortage of equity out there, Sam.
Yeah, agreed.
When there's a deal that's priced well, or just what we'll call a good deal, for lack of a better term, there is a myriad of equity looking at that transaction. Problem is,
absolutely.
There's a lot of dogs, but not enough bones. That's kind of the part of the problem.
Yeah, there is. I think we do have a world where the number of good quality investment opportunities, and what good quality means is going to differ depending on who you are. For a large cross-border institution, a good opportunity may be narrowly focused on relatively new Class A assets in near transportation hubs in gateway markets. Whereas for others, it's going to mean an asset that is fundamentally of good quality, but maybe undermanaged. And so some of the upside comes from just the management and operating skill that you bring to bear in taking that asset off the hands of someone who is struggling to execute. So what a good opportunity is will differ depending on who you are from an acquisitions perspective. But sort of in some cases, a dearth of opportunities to deploy your capital is really the issue. There is still, I think we do have sort of these bid-ask spreads, and some sellers who for whom the moment of truth will be their refinancing point. But overall, I think the expectation is that while there's been a bit of a pause or sort of in momentum in the first quarter, that we'll continue to see some improvements this year. There are wild cards out there. our most recent measures of headline inflation are closer to 4% than to our target, our strong
Yeah.
target of 2%. So that impacts monetary policy, that impacts the yield curve. There are there are reasons to be watching the labor market closely. Those are all very, very real things. But smart operators, smart investors, are clearly watching all of those very closely.
Sam, that I appreciate that perspective. It's very helpful. So we just spent some time talking about what we'll call macro and capital markets and how that plays out. Let's go back to the state and federal capitals here and talk about changes in housing policy. And what we're seeing is a continued regulatory trend to deal with affordability. And that's continuing to play out and play an increasingly big role in decision making that's shaping the future of housing and housing investment. There's a number of policies that have been monitored most closely right now. We've had the Road to Housing Act. We've seen a myriad of rent control measures across many states, including some that are playing out in places like Massachusetts right now on the ballot. We've seen good trends in housing affordability policy with more tax credits, more public-private partnerships. What do you see on the horizon from a policy standpoint that will affect the economics of housing and multifamily?
Yeah, I mean, I think, for both of us as folks that, are mindful of the implications of, affordability on, a broader range of outcomes for households. The fact that, people across the country and across the spectrum are focused on affordability tells us two things. One, we're likely to see some momentum, but two, that there's a broad recognition in the public discourse and at the in the voting booth that the affordability issues are very real in the United States. What I think we do see as a big difference, as we then take the next step of saying, okay, well, what do we do about it, is two very different visions for how it is that we tackle affordability challenges. At the federal level, when I look at Road to Housing, I see a lot in there that's designed to encourage new supply. And that, from my perspective, that is a very good thing. I think we do want, notwithstanding issues around sort of where we are, at different points in the cycle, allowing it, making it a little bit easier to improve assets, existing assets, to build new single family homes. These are good things. But one of the most challenging provisions of the Road to Housing Act, in sort of speaking purely from the standpoint of exactly where we are today. It's the House version of the legislation takes out some of the some of the features of some of the BTR provisions, the build to rent provisions that were most onerous.
That was at the congressional level, though, right? The Senate
that's
bill
at the congressional level.
Huh?
So so now it goes back to the Senate. And we'll see sort of what the Senate does with it. There's some reasons to believe that the Senate will get behind this in whatever form it is, because of some encouragement from the executive branch. But there's also a possibility that they could tussle a little bit over reconciliation. So, but we'll find there's a good chance that we'll find out after the Memorial Day recess and over the next couple of weeks in June. If it doesn't happen then it's going to be a little bit it's going to be a little while. But overall, I think folks in the industry have expressed that they're pleased with the changes that they've seen, particularly as it relates to some of the problematic BTR measures. And we'll see what happens next. I think from many local jurisdictions, though, while there is a recognition of the need for more supply, and certainly we see that in New York, at the local level, that's really where we see some of the measures that are you're likely to act as significant headwinds to new supply. The one that I'm keeping an eye on most closely is you raised the example of Massachusetts. That's the one that I'm probably watching most closely right now. There's the potential for a statewide control on rent
They haven't had rent
increases.
control there in over 40, 50 years now.
Yeah.
And that's why you've seen such growth in Greater Boston.
Yeah. But I think what this tells us, given how long it's been since they've had this, and given sort of the magnitude of the market intervention that's being discussed, is that jurisdictions that tackle supply challenges in a consistent and well considered fashion over the long term are the ones that are going to perform best, right? If you wait 30, 40 years for deterioration in affordability to really stretch the limits of household budgets, then you're going to sometimes get these kinds of very strong reactions. And so, what I like to see in terms of sort of a municipal local framework is this a city where the measures and structures are in place that we're trying to maintain affordability and new supply over a longer in a way that's fairly consistent. What I watch a little bit more cautiously is places where the problem is allowed to sort of get worse over a protracted period of time, because that creates the possibility of a real sort of a stronger pushback that actually makes the problem a bit worse. I think when you introduce rent control measures, particularly ones that do not allow for the rent to rise in a way that is consistent with expense growth, and that allows for for investors to earn a reasonable market return. If we do not satisfy those requirements, we will not get new building, and if we do not get new building, then over the long term, challenges become worse. I've been in Massachusetts quite a bit over the last couple of months, and have had the opportunity to talk to a lot of folks that are involved in different facets of or have very different perspectives. Let's say on what's happening right now, and I think there is a broad understanding that the current measures are having a chilling effect on some of the projects that have not where construction is not underway, but that are in the pipeline now. If you're, for some folks who are incumbents in the market, if you own an asset, if your acquisition strategy has you acquiring existing legacy assets, that may benefit you. The supply constraint, can be helpful, but does it support? But we need to find sort of the right balance, because long term, unaffordability, is not something that benefits the health and vibrancy of a local economy.
It also depends, Sam, on how draconian these measures are.
They really are in some
cases. When you start tampering with vacancy decontrol, and there's no incentive for the landlord to improve the real estate, let alone develop the real estate, then you're really tampering with supply-demand economics. Whereas what we've seen in a number of states, including California, Governor Newsom instituted during the COVID period and during the fires an anti-gouging measure. And that put a natural upper limit on rents, which everybody accepted widely. There was no resistance to that.
Yeah, a very different set of circumstances, during COVID, where there's lots of things that we might have done differently with the benefit of hindsight, but measure, from my perspective, and it's certainly informed by sort of my view of the importance of housing, stability and security, during the COVID pandemic. Ensuring that whether it be from a public health perspective or just from a housing and household stability perspective, ensuring that people whose incomes were severely interrupted by the pandemic were able to remain in their homes, that their kids were able to access the same schools, the continuity of the the social and family relationships that are part and parcel with where you live. All of that was very important. Just some of those measures far outlast the pandemic. In a way that was to the detriment of all of us. Yes, I mean, I think sort of once the labor market had reasserted itself, once families' incomes had restabilized, there were a lot of places in which these measures lingered for a long time. and much longer than they might reasonably should have. But these some of these new measures that are being discussed that would introduce long-term controls, where again we're only going to get the private sector to participate in these markets if we can generate a reasonable return for the capital that they're putting to work. There is no way to motivate private capital without a market return. And there is no way to address this problem without the participation of the private sector. So some of these measures that seem naive to what is happening on the expense side and what costs of capital are, or opportunity costs for investors, I think are going to be to our disadvantage if they're adopted.
Hey, Sam, let's just go one step further. You talked a little bit earlier about some of the supply issues and supply pressures that are shorter term. And then you have what we talk about all the time are long-term housing shortages, particularly in infill markets of the West Coast and the Northeast. How are you thinking about that dynamic today, particularly in some of the high supply Sunbelt markets, which have had a lot of growth over the last decade? They seem to be going through more pressure right now.
Yeah, I think you're absolutely right. When we look across a swath of the Sunbelt markets, where it's not just that the supply was a response to the very favorable migration trends. It was also that in many of these markets, it's just a lot easier to build than it is in the Northeast or the Midwest or California. So the convergence of those two things meant that in some of these markets we really did see a strong new addition to the inventory. Again, when we think about this from a cyclical perspective, it will take some time. But there's already evidence in many of these markets, and in recent quarters data, that net absorption has turned positive, that and that vacancy rates are stabilizing or beginning to decline. It won't be fast enough, for every investor in the market, but for investors that have a longer term view, particularly those investors who know that they can generate alpha through stronger operating fundamentals, whether that be getting the right set of tenants, whether it be their capacity to control expenses or make the right set of improvements. But most importantly, folks with a longer view and with longer term capital that they're putting to work. There's in many of these markets, given some of that negative sentiment, now is the time when you should be looking for investment opportunities and thinking about acquisition. In in places where it's been more difficult to build. I mean, we talk to folks in New York City, about are being oversupplied on a cyclical basis. Again, not longer term, but there being a lot of supply, in the Sun Belt. That you're talking from their perspective, you're talking about a completely different world, because that is not the lived experience of almost anyone who lives in the New York City metropolitan area. No, so there's a lot of differences, across the country. But I'd say that, in those markets where we have seen significant new supply come online, that is making it challenging for the less skilled, folks who don't demonstrate operational excellence. This is the burden of what's happening really falls on them. But for folks with more patient capital and who understand sort of how the cyclical dynamics create opportunities, what I'd say, Bob, here to try to be a little bit more concise that is typical for me, every market has an acquisition opportunity. It depends on where, thinking about what that acquisition opportunity is, you have to be very, very mindful of what are your own execution capacities, what does your access to capital look like, and where are we in the cycle in that market. But if you have a good, an honest, unbiased understanding of those things, there's an opportunity in every market, that I look at today.
I think you're spot on, Sam. And it's a matter of whether you want to get in front of the herd or behind the herd when you're at the inflection point cycles. So let's just talk about, give multifamily a report card to sort of wind down here. As institutional capital and foreign capital sees opportunities to come out across the real estate commercial sectors here, how do you think multi is viewed relative to other sectors, hotel, retail, data centers, and so forth, medical? And do you think the multi-sector's long-term investment thesis has fundamentally changed in the higher rate environment? What's your report card on the multi-sector overall?
Yeah. I think for many large institutional investors with a long investment time horizon, the best, they continue to view, and I think rightfully so, that the best long-term risk-adjusted returns are in multifamily. Right? It will demonstrate the strongest long-term stability, and that is apparent to investors again, who can see past the vagaries of the short term, the short term features of the cycle. But long term risk adjusted returns, for many large institutions, I think the focus is on multifamily. And that again reflects a combination of so many of the different things that we've described. We did not dig in on construction costs, the impact of construction costs, constraints on skilled labor supply, and how those are impacting our ability to deliver new multifamily inventory. All of these are very real features of the market. So it's a very sort of rich conversation. But on balance, I think multifamily is viewed quite favorably.
Thank you, Sam. I think I'm going to stay in the industry just a little bit longer now that I've heard this, along with everybody.
Yeah.
Well, Sam,
I don't mean to be Pollyannish. I'm not drinking multifamily Kool-Aid. But I think you're looking at the data and understanding what the data tells us about the long-term performance of the sector, the underlying drivers of demand, variation in our capacity to bring supply online, the policy and political dynamics, the combination of these things. I think is very supportive in the long term of the multifamily sector.
So, Sam, to wrap up our discussion today, this has been great. When you look ahead 12 to 24 months and you're focused, what are you focused on and where do you remain optimistic about the future of housing, multifamily, and just the broader economy? I mean, you sort of stated that earlier, but if you look ahead 2 years, let's say.
Yeah, but I mean, the thing that I'm most optimistic about is one, we've demonstrated a clear resilience in the private sector in the United States. The last year and a half in particular, we've been buffeted almost daily. There's by some news, some policy development. And there's a lot of noise there, and that has created an environment of uncertainty. Many things, many features of our world feel unpredictable. That by the textbook, that should constrain investment activity both at the household level and at the level of business. But the economy has continued to grow. The private sector, albeit more modestly than a couple of years ago, has continued to hire. There is some softness in those numbers, but the private sector has demonstrated a lot of resilience. The U.S. economy is growing more quickly, than any of our peers. And that's one of the things that I feel very good about. Some of the sources of concern that I have, are that too much of our growth right now depends upon the massive investment that we're making in our AI infrastructure. I have no doubt that demand for compute, and the range of applications of AI in the economy, will continue to grow. I don't have any doubt about that. Is there a possibility that we'll see some correction in valuations for those AI companies? That many of the very well funded AI ventures will fail. I think those kinds of things are inevitable. So we have to see sort of what kind of impact does that have on stock markets? What kind of impact does that have on our investment portfolios? So I'm not worried about demand for AI and compute, but I think we have to watch to see what happens with some of these corporate valuations that look a little bit or a lot rich. The other is I think we have to watch the labor market. I'm very, very mindful of this, because my students are, I'm always talking to folks who are moving into the labor market for the first time or for the second time. The needs of the labor market are changing more rapidly than has ever been the case, and that is a function of the rapid change of technology as a function of how our economy works. It is incumbent upon academic institutions whether they be universities, community colleges, high schools, to ensure that we are making it as easy and seamless as possible for people to access our resources, to acquire new skills that will ensure their continued relevance in the labor market. And I do feel very strongly about this. It is absolutely the case that we must be doing more to ensure that people who are displaced by the changing needs of employers are able to access the resources which we have in abundance. It's not to say we don't have endowments and dollars in abundance, but we have our capacity to support people in maintaining or growing their relevance. When we look at the set of job opportunities that are emerging in a technology-driven economy, we have that skill in abundance, and we need to be doing more. If we are in a place where certainly some jobs will be destroyed by the technology and AI revolution,
well, jobs will change,
term,
let's say.
jobs will change, right?
But new
On that,
jobs
we know
will
we're
come
going to
from
create
it.
more. Yeah, absolutely. But whether or not how well we capitalize upon that depends upon how ready the workforce is for those new job opportunities. It's not going to happen by accident, but it is the academic infrastructure of this country that has a big role to play in ensuring that people are ready. And I really, really believe that we need to be doing more there, and that is part of our social contract in the United States.
Thank you, Sam. You are a treasure to everybody. Academically, training the future young minds of real estate coming out of NYU. Very proud to serve as a board member with you at the Chen Institute. And I hope to see you in Abu Dhabi here as we move to a more peaceful situation in the Middle East here, hopefully in the fall, Sam.
Absolutely, Bob. I'm so grateful for the chance to talk with you today, and for everything that we have a chance to do together. Your support, of the Institute, and again, sort of the work you're doing, with the team at True in advancing access to workforce housing and ensuring that sort of in markets big and small, teachers, firemen, police officers, all of the people that make economies work, that make them competitive, that they have a place to live in the communities that they serve. That's the important piece.
That's why we call it TruAmerica.
That's right. So I just want to express my gratitude for everything that you and the team are doing there. And again, hope to see you soon.
Sam Chandan, building a better community. Thank you.